Hello, everybody. All right, we are back. And to get us warmed up for our next session, we had a pretty good time with Finn and Brennan, but we've got another poll lined up for you guys. So the poll I think that we're going to launch here in a second, it's going to say, what percentage of your clients are you currently providing tax planning services for? Let's see. Oh, here it is. Oh, here we go. It's so fun when there's so many people in here. It moves so quickly. It's pretty well stretched out, honestly.
Looks like 50 to 75% are
Or winning. That's good.
neck and neck right now. Yeah.
That's where we want you to be, even higher. Let's see, we've got probably 5 more seconds to get for everybody to get their participation in. Mm. All right.
Yeah, pretty solid actually. That's really impressive.
I know.
So
If you're not doing tax planning for majority of your clients, we do have our next two speakers are going to tell you 5 things that you can do for your clients by the end of this year. So we have our own Roger Pine and Ben Birken who are going to hop on to present next for us. For those who don't know them, Roger is our co-founder and CEO, and Ben is our vice president of customer support. So they're very excited to hop on and share with you guys next, if they will enter in. They're hiding from us in the backstage. There's a
where
chance
are they?
I want you to fetch
They're
them
going to
from the
leave us to
backstage.
present
There we go.
ourselves.
I left them both in the backstage. They were there.
They wanted us to do our stand-up comedy bit.
I know. Should have prepped better for this. There he is.
Sorry, I got there. Ben's still figuring out the button to enter the webinar. There's like a button that says enter webinar. There he is.
Look.
Funny, it just says webinar. Doesn't say enter. Now, maybe that's on me. But Roger, I was noticing that like on the pictures of everybody who is presenting today, they're all wearing like nice clothes and jackets, and you and I are there in like short sleeves. So, par for the course. I can't figure out how the webinar stuff works at a technology company, but that's for another time. We'll worry about that.
It wouldn't be you guys if you didn't take 2 minutes to enter in. So
yeah. Well, thank you for bearing with us, everyone. I appreciate it. And Kate and Alana, thank you for all your work getting this together, this event. I know this is not a small amount of work, so I appreciate your efforts in advance of today and then during the day today. So thank you. All right. So Ben and I are going to talk about, first of all, yes, they introduced Ben well. Ben is our vice president of our whole customer experience stack. So they mentioned support, but Ben also runs the team that does all the data entry stuff when our automatic OCR system needs a little help reading in data. And Ben's team they're staring in the face of a very busy quarter for them. The fourth quarter of the year is the most busy time for us. It's not April and May. Like I would have thought when we started this company, April and May, because we got famous with this whole, you upload a tax return and the system reads in the tax return. In April, May, that's when you're reading in tax returns. No, Q4 is by far our busiest time of year within the software and with traffic and then work coming into Ben's team. Ben runs a great team, by the way. He's got probably more CFPs than a lot of financial advisory firms, I'll say. Busy time for them. And the reason for that is because tax planning is super unique, right? December 31st is a deadline, and you got to get it done by December 31st, with a few exceptions, I know, around SEP IRAs and stuff like that. But in general, your tax planning has to be done by December 31st. And what's fun about tax planning, or what's unique about it, is we get to do it every single year. Right, every year we get a new tax year and a new year for us to do something for our clients. It's in contrast to say your estate plan. Like my wife and I are behind many years updating our estate plans, and you can always kind of like let it go another month because there's no deadline. Estate has a deadline, December 31st, and so Q4 is always very busy for us. Now, I appreciated that poll that I saw that asked, how many of y'all are doing tax planning for all of your clients? How many of you are doing a workup for all your clients every year? And the results I saw generally align with both the anecdotal and the hard numbers that we've seen around this question. So, and so you might be on this call and you might be like, I do it for all my clients. This presentation is going to make you feel good because you're probably already doing a lot of things we're talking about.
You get a
But
gold star early
yeah,
in the
you
day.
do. Yeah, maybe you can join in a little later. But there are a lot of people who are still on that journey and still trying to figure that out. So anecdotally, you know, I went to like 2 or 3 conferences this year. I think I've got a couple more coming. And one of the things that I like to do when I'm like at the booth or something and someone comes up to me and it's the one time I get to hear positive feedback. A lot of times I only get to talk to people when they're mad. But people come up and they say great things. It's like, hey, I love what the product's doing. It's been very helpful for our company and all that stuff. And usually I will follow up that question with how many of your clients actually get your full suite of tax planning services? And in general, I hear 10 to 30% is the answer I get. And that's people who've come up and they are using the product and they're excited about what we're doing, right? Our stats generally back that up. So one of the things that's kind of unique about our business is we're able to see because I mean, those of you who have to file with the SEC, you have to file like how many households do you serve? It's on your ADV. And every once in a while, we'll kind of just like poke around and just check like how many households in our system versus the number of households served by the advisors. And it works out to about 25%. And so the next level down is like, okay, why does that happen? Like, how come all of our clients don't get the full suite of tax planning services that we offer? And we get different answers on this. I think they fall in 3 main categories, I would say. One is the viewpoint that not everybody needs tax planning. I mean, honestly, I've got a couple clients who they're W-2. There's not a lot going on with them. Or I've got a client, he's 91 years old and all he has is Social Security. There's not much going on there either. That's one argument we hear. We also hear, and this is the one I get the most when I'm talking to someone like at an event or something and they're using the product, that they'll say, well, the reason not all of our clients get tax planning is like, I'm the only CPA in the office. And so like we can only do my clients and not the other people's clients, or we just don't have enough people in the firm who know taxes in order for us to provide those services for all our clients. And we'll talk about that today. And then the final one is, the final category is like, we just don't have time. Man, we're busy. We're doing other stuff. We just can't work in this full service for all of our clients. We got to pick and choose who get that. And I understand that one. That's the one that I understand because we all have different business models and how we provide planning services to each. I would argue that a lot of those, all 3 of those really come down to, in part, a question of process. I would argue that business processes is a big part of why it's hard for some firms to deliver full suite of tax planning services to all their clients. I would argue that if you do have a robust process in place, and we're going to show you some examples today, your whole building does not need to be full of tax experts. If the process is robust, you can allocate the work that needs to go to experts, and the parts that don't require experts go to not experts. Our friend Debbie Taylor, who presents for us quite often, I think she does an excellent job within her firm of routing tax planning work to the people who are able to do those tasks. And we're going to show some examples, more general examples, but she does a good job, I think, within her firm of scaling tax planning by putting the work with the people who are able to do the different types of work. You don't need a whole room full of, 30-year CPAs to do tax planning effectively. And yeah, again, it's similar to the confidence in being able to do the work. Also, the time to do the work. If we're able to spread the work out across the resources in the organization, you can also then free up more time to do tax planning for all clients. So again, process is at the core of that. And I would argue this: if the process does support it, you really could deliver some form of tax planning to all clients. And I would argue that even if one of your clients just really and truly, there's just nothing to do interesting with them for tax planning. Like you just don't find anything. I would argue it's still valuable to do that work for them because at least you looked and at least you told the client that you looked, which has value to the client. You may not sense that it does, but it does. I just had my garage door fixed yesterday, Ben. There's like the big spring broke.
I'm familiar with it.
Well, I'm not. It broke and you couldn't
I
open
mean,
the
I'm
door.
familiar with the spring. I'm certainly
Yeah.
not familiar with fixing it. I'm
Yeah,
an
yeah.
inside kid. I think we all know that.
Right. So this guy came in, and what I appreciated was he's like, "Look, I'm going to fix your spring, but we're also going to do a 20-point inspection of your garage door opener because while I'm out, this is what we're going to do." And I really appreciated that. He looked at the uh-oh, Ben, I don't know any of that. This is a bad example because I don't know any of the parts of a garage door.
Well, there's a
The
motor, there's a
yeah, he looked at
door,
that.
there's
There
a
were
chain.
wheels. This is a terrible
I'm
example,
out.
but he looked. Yeah,
I'm done.
but I appreciated that he looked. And honestly, our clients feel the same way, right? Our clients don't know everything about taxes, but they hired an expert, you. And if you're able to say, look, I looked through your tax return. I do it every year for you. It looks like honestly you did everything just fine. And that's okay. I'm going to look at it again next year. That has value to the client. That reminds them why they're paying you to be their advisor. Right?
Yeah, I always think about this, Roger, from the standpoint of even if you don't think you know anything about taxes, I guarantee you probably know them more than most of your clients. And that, just telling them that, hey, everything looks okay, the sigh of relief that they get, they don't understand. They just don't. And some of them do, obviously, right? You have people who care about this stuff, but most of your clients don't understand how taxes work at all. They don't need you to know how every part of the tax code works, but it is a nice reassurance when you tell them, yeah, I looked at it. Here's what you paid. You did everything right. You couldn't have done anything more. Gold star for you. Like that's huge.
Yeah. Actually, you know what I keep on my desk this here. For years I've had this on my desk. This is what the auto dealer gives us. That's the 20-point inspection. I know as much about cars as I do about garage doors, or I know about wheels and brakes. So maybe I know a little bit more, but I keep this because I appreciate that they tell me that they've looked at these things. And even if it's all green, that doesn't mean that it's not valuable to me, right? If you do a tax return planning process for someone and it ends up being all green, you still did something valuable for the client. Anyway, I've had this on my desk, various forms of this for over 10 years. Okay, so today we're going to talk about building a process, okay? We're not going to be going into a lot of like detailed, nerdy tax planning stuff. We do plenty of that stuff in other webinars. What we're trying to build for you today, what we're going to try to build together is a process and the infrastructure behind the process that will allow you to do, we chose 5 like super simple things you can do between now and the end of the year. And it's still tax planning. You're not going to be on stage at the AICPA for these things, but like this is tax planning and your clients will find it valuable. I promise. Okay.
Yeah, and just to be, we will do a little bit of nerdy stuff.
Yeah.
For the folks that want it, like we're gonna have to throw a little bit of nerd into this smoothie, but not a whole bunch.
Yeah, we've signposted it enough. Let's start. Okay, so the first step. So I'm a believer in when it comes to like financial planning and try to do it in a scalable way. I am a believer in what I call the assembly line approach. A lot of people talk about like the financial planning calendar. That's another flavor of an assembly line approach. To me, the way we can do these things efficiently is we need to take a subset of things that we're going to do as part of this financial planning service. We need to grab a list of all our clients, and then we're going to go through them all in one project. Okay. That's different from just picking it up whenever they come in for their meetings or anything like that. In an assembly line process, you always start with a list of your clients. Okay. So I know this sounds super basic, but we're going to do that. We're going to start with a list of our clients. I'm going to share my screen. All right, hold on. Why do I just see Alana and Kate? All I see are like caution signs about sharing my screen. Why would that be?
Throw caution to the wind, Roger.
Ben, you might have to share your screen. Let me just try.
It should let you just go ahead.
Ben,
Nice little green share button down there at the bottom of your
yeah,
screen.
you know what? I have a new laptop and I have not given permission for my laptop to share my screen with Zoom. So Ben, while I
Okay.
scramble on that, I'm going to ask you to share your screen.
Okay.
That's all right. We can do this.
And what
We
would you
work for
like?
a technology company, y'all. So Ben, can you open up the household listing screen?
Yeah.
On your side?
Mhm.
All right. We can get there. We're getting comments from our colleagues laughing at us, but we are going to do a good job on this. So the household listing screen. So you, advisor watching, you have plenty of systems on your desktop that have a list of all your clients and can download a list into a spreadsheet. Holistiplan is one of them. So we're going to show you how to do it within Holistiplan. There are some benefits for doing it out of Holistiplan. But yeah, you have other systems. Okay, go ahead, Ben. Household screen. Go ahead and
Yep.
download that to Excel or whatever you use. All right. Someone wrote, the people love this stuff. The people love to see us screw up. Okay. Did you download that to Excel? Let's see it in Excel.
Sure did. And
All right.
here it comes. Say something funny for the people while Microsoft 365 work. There we go.
I can't see it though.
Yeah, it's because
There it
we
is.
go.
Okay. I have a list of all my clients. So what I want to do is we're going to do 5 different tasks for our clients here. First off, we're going to look at, hold on, let me pull up my stuff to now. I'm all messed up because of our problem here. We're going to look at salary deferrals for next year. You could argue that's retirement. So Ben, what I'm going to ask you to do, could you just add like add 6 columns? And then we're going to create a column for each of the things we're going to do at the end of the year, right? We're building the infrastructure that allows our firm, for however many advisors and paraplanners and associates we have, we're going to track the things that we're doing for these clients or not. So one of the projects is salary deferrals for next year. You can just call it salary deferrals if you want. We're going to look at end of year charity. We're going to look at RMD planning. We're going to look at capital gains harvesting. And we're going to do Roth. And we're going to do a grab bag of special situations. And I'm confused as to why you had 2 extra columns, but that's okay. I don't understand that. But so that's step 1. Step 1 is as an organization is to agree on what are the services that we are going to include in our end of year tax planning offering. Okay? I know this sounds like super simple and basic, but like if you asked your nerdiest tax planning friend, they're going to give you 45 columns to put in this spreadsheet. And the problem with that is if you put 45 columns on the spreadsheet, you're going to be like, I can't do this. I can't do tax planning. It's too much. So that's why we chose 5 things. These are 5 things that really anybody can do. The grab bag, we'll talk about. That's like special stuff. So that's step 1. Step 1 is we're just going to agree as a firm. These are the 5 things we're going to do. And we're going to commit to doing these for all of our clients. Okay. So then the next one down then is, and I had a really good example on my laptop for this, Ben, which
I believe it.
maybe I'll be able to show if while you're talking, I can figure out how to do this stuff. But the next step then is, and we don't have to do this in the heat of battle. We can do this during the summer, or we can do it now because it's September. It's not quite Q4, but sometime during the year, we can do the work as a firm. Usually the advisor who owns the relationship is the best person to do this. They can figure out which of these services are each of these clients going to get. Okay. So not all of your clients are going to have RMD planning to deal with. And similarly, probably there'll be very overlap between that group of people and the group of people who are getting salary deferrals, for example. And so what I had on my little spreadsheet, Ben, was I had a 1 in the places where it was, oh yeah, Ben's helping me out here. You're giving away what's next. I put a 1 in the people where we would give them that service, and I put a 0 where we wouldn't. So let's look at the RMD column actually, Ben. And this is where actually using Holistiplan to generate this spreadsheet may be helpful to you. Ben's, it's amazing, Ben. We've worked together for so long. You know exactly like where my brain is going, which I appreciate about you. We actually have in the system, when you download this to Excel, like who is RMD eligible. So with that age milestones in column V, what I did in my brilliant spreadsheet, which y'all can't see, I was able to just say, look, if RMD age is in there, put a 1 in there. If RMD age is not in there, put a 0 in there. So within the system, we can signpost whether or not these people will receive that service or not. So we can start to populate this spreadsheet based on what you're already pulling out of Holistiplan. Now, if you already have this tagging in your CRM system or something like that, go for it. I'm just, because we know our system well, that's what we're showing you. So I'm agnostic as to how you generate this tracking spreadsheet. You'll notice in column W, so column V, like Holistiplan can generate certain tags for you based on how old the person is. You can also generate your own custom tags that you can put on people. And here I was just playing with, I put like, these are the people who are accumulators. Those are the people who probably I would say we need to have the salary deferral conversation with, right? And you can go deeper. I could even say like, give a tag to the people who always are accumulators and are always maxing out, right? These are the things that it takes time to build up that infrastructure. And then once that's built, this spreadsheet is dead easy to build. And so at the beginning of the season, you would generate this spreadsheet, or probably at the beginning of the year, you would say, look, we're gonna commit to doing these services for our clients, these tax planning services for our clients. Next step, during the year, again, don't do this in the middle of Q4. Do this during the year when there's time to think which of our clients are going to receive these various things that we look at. Not all 5, they're only going to get a subset of them. And you set that up. Then what happens is, now that we've entered Q4, we're sitting on October 1st. Now we have a guide. We have a guide for who's getting what in terms of what services. And we're able to also check off as we go along who has actually received those reviews that we planned for them to receive. So Ben, shall we go into the first one? And again, you'll have to drive. I promise I'll try to get my screen sharing while you're talking, but I'm still doing the talking. But I will say this. So yeah. So I think it was, who was it, Ben?
These folks, right?
Was it Beard?
Beard. Yep.
Yeah, sorry.
I got you.
Well, I got the wrong thing open. I got so many screens, Ben.
I believe it.
Roger,
Oh my
you
God.
missed our poll about how many tabs people had open before this started.
I have tabs open on all screens, and I had it all set up, but then I've kind of been thrown for a loop but on my own doing, of course. I did want to say this before we dig into Beard. I know I've been yapping a lot about just setup, but like setup is the thing. I recommend doing a kickoff meeting. Oh, you're putting it. Sorry. I recommend doing a kickoff meeting because, okay, October 1 has happened. We've got the plan of who's getting what services. We've got the plan, but like which people in the organization are going to do those things. Okay. Salary deferrals will come back to who was probably the best place to do this, but let's just show like what you would do with salary deferral. Okay. It's usually about mid-November when we will hear what the new maxes are for our salary deferrals. So that's a good example of something that you would want to be prepared for, because you only have a few weeks at the end of the year to like communicate out to all your clients, come up with a plan for fixing their salary deferrals. So the more planning we can do in advance, the better job we can do delivering that service to people. And so what we had here, so this Beard family, if you actually, Ben, could you go back to the household, click back to household on this one? I chose Beard because not only do they max out, that's a thing I could have a tag for, but they're an accumulator. But notice that Jaden George, or maybe George Jaden, I don't know. These are all names the computer came up with for me. They turn age 49 this year. So they will turn age 50 next year. And so I used that same spreadsheet that Ben downloaded to identify who's turning 50 next year. And so I was like, oh, there's an interesting thing to talk about with this client about their salary deferrals. Namely, they're now going to be eligible next year for a catch-up contribution. So that's what we were going to show. So this is the part we wanted to at least show some of what the actual process would be. So again, like we made a spreadsheet. We're going to do salary deferral reviews. What is in scope of that review? One, are they already maxing out? That's a thing we should ask. Two, is something changing about either their employment status or their age? That means that the amount that they can put into their contributions is different. And that's kind of it, right? And then I would argue anybody in the company could do this. So what Ben's drawn up here is we had a client, this client, they make 150,000 each, and they're each maxing out that 23,500. I guess that was the amount for 2025.
Mhm.
So we don't yet know 2026. We could probably make some educated guesses. But then if you pop open, there you can
Yeah, so
see.
we would change this to 2026.
Oh, right.
Right.
Okay. And then, well, we guess we should have had both on 2026 then. Well, then we give Jaden George / George Jaden the extra catch up. And so that's where we're able, if you wanted to show your client, this is the difference. So Ben, if you wanted to like open up the delta difference piece, if you wanted to model out for your client, look, let me just show you how great it is that you can now do these extra contributions. You can model that within scenario analysis and show them, right? In this case, they save some money. Yeah,
Yep.
$2,400.
Yep.
That's not bad.
Nope. And I think, the key here is, yeah, you want to show them the tax implications, but the conversation with these clients probably needs to start the year prior, right? So
Right.
let's pretend that these folks are, it says tax year 2025, but we're thinking about tax year 2026.
Right.
Not everybody can just come up with $7,500 of cash flow for the extra catch up. So you start that conversation before you have them do the deferral, so you can model, okay, can they even do this? Right? Are they even going to be able from a cash flow perspective to do this? Sure, you can show them the tax savings, but you have to start prepping the, okay, do you work at a company that automatically does this for you? Some companies you just have to check a box and it does the max based on your age. Other folks are using, maybe less modern 401k or retirement plan providers, and you got to do some manual math. So if you want to make sure that they're going to hit by the end of the year your new top out amount, you might have to submit a new form in January, so you make sure you can spread it out over the course of an entire year, as opposed to changing stuff up halfway through the year.
Yeah. So that's why we do it in Q4 of 2025. And so that's why we need to be prepared. And I'll say this, you do not need to be a tax expert to do what we just talked about. You really don't. Anybody in the firm can do that. And so that's why I would argue that process is actually going to allow you as a firm to do this. I would argue this is tax planning. You might say, oh, this is in the retirement planning category, but this is tax planning. It's both. They can both be true. But you do not need to be an expert in tax to do the work on this. So I would argue if you have a solid process, if you've identified in advance who are the people who are going to get what we just did in like 2 minutes, anybody in the firm can do that. It's a process story. Now, if you want to get nerdy stuff, I think you should, as part of your process, say, person who's doing this, associate who's doing this analysis for me, please bring to me as an escalation anybody who it would be eligible for a workplace retirement plan, because we should probably talk with them about defined benefit plan or talking about SEP IRAs if they don't have it. So there's always layers to what you can do with this. But if we're just trying to do a basic, get it done by the end of year thing, like getting people who are maxing out to max out without surprises is in itself a win. And you can do it for all your clients. All right, Ben. The next one we had up was charity. And while you do charity, I promise I will try to get my screen shareable on my end. How's that?
That sounds fine. So for charity, we're going to talk about 2 different examples that are related to charity. They're both going to end up with money going to charities, but how we get there is slightly different. So the first one, and one of the more common uses that we see inside of holistic plan, is for folks who are 70 and a half or older, being able to first recognize that they're eligible to do a qualified charitable distribution. So remember, for those who aren't immediately aware, qualified charitable distribution, once you turn 70 and a half, you can send money directly from your IRA to charity. Does not go on your tax return. You don't get a charitable deduction for it, but it's because the money never showed up on your tax return. And if you are eligible or required to start doing required minimum distributions, your QCD can count towards your required minimum distribution. There's a certain dollar amount that tops out. You know, it's a little over $100,000 now for how much each taxpayer can do as a QCD. But one of the benefits here, of course, is that for those who are not able to itemize, this is almost a 100% tax efficient charitable deduction or donation, right? Because the money's never going to show up on your tax return, never going to get added to adjusted gross income. And we know that adjusted gross income then also has some implications about deductions and credits that people are able to take. So that's one. Why do you need a deadline? Well, because you have to do it by the end of the year. Right. So if it doesn't happen by the end of the year, it's not going to count for this year. So you got to have a deadline. You also have, you know, some folks, they give their clients, I think Roger's firm used to do this and maybe they still do, but they give their clients a checkbook related to their IRA so that rather than you processing a whole bunch of small QCD requests through your custodian, you just have them write a check. Now, there are pluses and minuses to that, and time depending, Roger and I can argue about the wisdom of letting folks write checks out of their IRA, but certainly some folks do, and it's very valuable for small dollar things where you're not going to file a form to do like a $25 QCD. Now, the key here as it relates to required minimum distributions is that you do need to coordinate with those RMDs, because while your QCD can count towards an RMD, it can't retroactively count towards an RMD, meaning that let's say you have an RMD of $100,000 and you take that required minimum distribution early in the year, you can't then do another $10,000 qualified charitable distribution and have it count towards the RMD, right? IRAs and RMDs work on this first dollar out rule. So that's the nerdy stuff aside. Here's how you would show that to somebody in Holistic Planner, or you can model it for yourself. So I've got these two folks. I'm not even going to pretend to pronounce the made up names that Roger gave them, but on their left-hand side, we've got their baseline. And we're assuming that for these folks that one spouse has a required minimum distribution, if I open it up in here, of $40,000, and the other spouse has a required minimum distribution of $30,000. If they had not taken their required minimum distributions yet, and they had charitable intent, we could show that, hey, if you wanted to give $20,000 to somebody or some charity, you could do it as a qualified charitable distribution. That's what we show here in scenario 2. We've reduced the taxable distribution down for spouse 1 by $20,000, entered the $20,000 here in the qualified charitable distribution column right here. And then when we scroll down and run that delta, we can see that by not having that extra $20,000 of income, a couple of things happen with this unique example. First, it actually reduces the amount of their taxable Social Security because it's brought their total income down. Because remember, that QCD never shows up on the tax return. It also makes them a little bit more eligible for the full enhanced senior deduction, right? So this brand new thing here in 2025. And so by doing that little piece, by doing that $20,000 QCD, as opposed to writing a check to charity out of your checkbook or even donating appreciated stock, right? Those things happen after the calculation of adjusted gross income, right? Those are after that. So you would not get the same benefit as you would by doing a QCD. In this case, the QCD saves these folks about $5,500 in taxes, right? That's pretty cool stuff. That's real money, right? And so when we talk about, sometimes, I think somebody brought this up in the last section about, do you use the phrase tax savings versus tax deferral, right? That is an important distinction. And sometimes people use them as synonymous, and that's not really true. Sometimes your tax savings is just pushing your tax bill out till later, which has value, but it's not always the same as tax savings. This is tax savings, right? This is $5,400 of tax that somebody does not have to pay just by doing this little qualified charitable distribution technique, as opposed to writing a check directly to charity. That's one charitable example. The second charitable example is for folks maybe who aren't able to do qualified charitable distributions because they're not old enough. And so they are doing that kind of more straightforward charitable contribution. Again, why does this have to happen by the end of the year? Because it just does, right? You have to do it by the end of December for it to count for 2025. So in this case, we've got a slightly different example. These folks are not yet at QCD age. They are taking, I believe, the standard deduction. And in this case, they have a charitable intent of wanting to give $5,000 per year. Now, if we only let them do $5,000 per year, they're never going to get above where that high standard deduction is, right? So the TCJA and the One Big Beautiful Bill Act extended the super high standard deduction as opposed to what things were like 10 years ago. So it gets harder and harder to get above that itemized deduction threshold. However, if we can say, and they have the ability to do, say, 3 years worth of contribution in a single year, either through cash or ideally appreciated security, since that's more tax efficient, and they could do a $15,000 contribution this year, we can model that here inside of our charitable deduction section. So here's their $5,000 normal deduction or contribution. They're only taking the standard. If we can up it up to 15,000, that gets us above the threshold to do an itemized deduction. And then we can see that our delta by doing that is certainly going to be a little bit more, right? It's not huge, right? It's something, and we've intentionally picked some low numbers, but that's still something, right? That's an $800, almost $1,000 savings, and maybe more on the state side. We do have a nice feature inside of Holistic Plan where if you are wanting to show folks doing these bundled charitable deductions, most of the time, but not always, people like to do this into a donor advised fund as opposed to directly to a charity. So donor advised fund is a gift to what is effectively its own 501c3, the donor advised fund. So you gift stuff to it and then you make grants out of it, and you get your charitable deduction when you make the grant to the donor advised fund in that first year. We have an explainer that for folks who have never worked with a donor advised fund before, or if you're introducing this concept to your clients, you can walk through what this looks like. So some information up on top and then some math down below where you're showing, okay, what if you just did 3 years of the standard deduction versus this one bunched year with your itemized deductions here, and then standard deductions in years 2 and 3, right? So you're highlighting here, not the change in taxes so much, but the change in the total deductions that you would get over that 3-year period. One thing too that we'll point out, although this is true every year, takes on a little bit more importance this year relative to next year, because next year we introduce 2 things. We introduce the concept of there's a floor above which you have to get, it's a 0.5% of your adjusted gross income. So your first deductions that are less than 0.5% of your AGI actually don't get counted on your Schedule A. And you kind of see that here where, when we go same income concept from scenario 2 to scenario 3, we've just changed the year. All of a sudden that $15,000 deduction gets whittled down to $13,820 because of that 0.5% AGI floor. That's part of the new tax legislation. The second thing is that, in 2026, we do have the reintroduction of being able to take charitable deduction, even if you don't itemize, right? So you can take up, $1,000 or $2,000 based on your filing status for cash gifts directly to charity. So that's going to be something new for 2026 that we probably want to start thinking about this year and thinking about who do we know is philanthropically inclined and what are going to be the best options for them. Do we want to do big stuff this year? Do we want to wait till next year? And try to map out what's going to be an optimal solution there.
Yeah. So Ben, you delivered on giving them some nerdy stuff. So I appreciate
said
you
I
doing
would.
that. But I would argue this. That one of the benefits of doing like what I again call this like assembly line approach is I would argue that what Ben just went through is actually very, very repeatable. And I would argue you don't need to be a Ben level nerd to do that. Right. So I would argue that, I don't know the names of different jobs in your firm, but like someone who is not a 30-year veteran of tax planning, yes, they're going to need some training on how do I model a QCD and communicate it to a client. Yes, they will need some training on how do I model a donor advised fund and communicate it to a client. But once you've done 2 or 3, like it's the same concept over and over again. We're going to start with whatever last year's deal was. We're going to talk about, they normally donate this amount to charity. Look how it changes if we either do a quick QCD or donor advised funds, kind of different story. That is a very repeatable thing. And so I would argue that anybody in the firm, once appropriately trained, and once you give them a list, like these are the 60 clients, take a week and do them all. That can be done. Yeah. What's harder to do is if you're doing it all at different times during the year and it's different people in the firm doing it, that's when people get overwhelmed and they just hear everything that Ben just said and they're like, whatever he just said, that's not for me. Because the reality is what Ben put together took him all of like 3 minutes because he had the enough of the history with modeling these things. The concepts themselves are not super hard. It's, yes, learning how to model them, but then giving someone the ability to just knock them all out at once in this assembly line process. That's how you can do these sorts of things for all your clients every year.
Yeah, and I would even take a step back. Like we said, we chose some nerdy stuff because it's in our blood. We can't help it. You can be a really good tax planner without doing what I just did. You really can, right? Because all you're looking for patterns and repeats, right? So what Roger said, and concept-wise, do you need to know every detail about how QCDs work? Does it help? Yeah, sure. But like if you know high level, I know what QCDs are and I know who they might be applicable for, you can at least start the conversation with a client and then work with a tax preparer to do those next steps. So yes, Holistic Plan will give you the tools to do that if you want to, but you don't need to be a master in scenario analysis and all the stuff that we have in here to be a good tax planner. You just need to know what to look for, I think is kind of the big takeaway.
Yep. All right, Ben, moment of truth. Can I share my screen?
Ooh, boy.
Can I share my screen?
The question of the hour.
Everybody calm down. Are we calm? Oh boy, what is this? Can we see my screen?
Yes.
We can.
This was the beautiful, like already baked version of the spreadsheet that I made, Ben.
Are you saying that my spreadsheet was not beautiful just because it didn't have Christmas colors?
Was this worth it, Ben?
It was for me.
We did
because I got to watch you sweat a little bit. So I think this has been fantastic.
What we didn't talk about is I threw in this grab bag. I don't want to complicate things. Like we want to very much like keep the scope narrow, like pick 5 things. But the reality is there are some cases where if you're already looking at this client, you probably should talk with them about other things. And so we had a couple of examples in here. Like I highlighted the people who live in New York, New Jersey, California. Like we should maybe have a conversation with them about what's going on with state taxes. Like, but maybe there's enough of those that's your 6th column. Okay. I'm not going to tell you how to live your life. We chose 5, but the reality is sometimes there are things that go beyond these 5 things. And if we're going to truly do a full tax planning conversation with the clients, we might want to just like look at their situation, talk with them about it. Again, I don't want to complicate things. Okay. The next thing we were going to look at was RMDs, and recall that I just flagged, and I just used a formula. Look at this. I don't know if you can see this up top. It may be kind of small, but I just used a formula. It said anyone who's RMD age, just like give them this RMD workout. So what's interesting about RMDs, you might argue like that's not really a tax planning thing. We've already done the tax planning. Now they got RMDs. Well, RMDs, there's the withholding question. There's like how much should I withhold from these RMDs? As Ben mentioned, when you put money into a tax deferred account, that was not tax savings, that was tax deferral, and now we have to pay the piper. And so there's a withholding question, and one of the things that you can do, Kane Graham is the one. Kane Graham, or maybe Graham Kane. I don't know. They're age 75.
These are your creations, Roger. You can call them whoever you want.
They are age 75. There's a withholding question for them. One of the things that my clients really appreciated. So those of us who are like living the W-2 life, like a lot of our withholding takes place through our paycheck. We have clients who have more like business interests, and they have to pay estimated taxes, and that's a hassle. I just had to do it a couple of days ago myself. And then retirees also, like their whole lives, especially, if they're just like run-of-the-mill W-2 people their whole lives, and now they withhold out of Social Security, and now suddenly they've got this big lump sum thing coming in from IRA distributions, and they're like, I don't want to pay estimated taxes on that. And I certainly had clients, Ben, I'm sure you did too, who once they started their RMDs, we were able to cover all of their withholding throughout the year just through their RMD withholding. That was a thing that they really appreciated. But if you're going to do that, now you have to figure out how much withholding to do, because it's maybe not just the RMDs that you're paying tax on, but any other income they have. If they have capital gains or interest income and stuff like that, now we're in a position where we kind of have to make a high level projection of what their taxes are going to be so we can know how much to withhold. And I will point out, by the way, I think a lot of people know this by now, but one of the kind of cool tricks about withholding from RMDs to pay for your taxes is in the perspective of the IRS, withholding happened throughout the year on average. So even if you took all the money out on December 31st, I would not recommend waiting till December 31st. But even if you do, the IRS gives you no penalties for paying late. Whereas if you tried to play a game where you pay all your estimated tax on January 15th, they're like, nope, that's not allowed. You're supposed to pay throughout the year. So that's one of the benefits of doing this. So what I did here was, here's a client who, again, one of them was age 75. They've got some RMDs, $61,000. They have other income. They do, by the way, I noticed that they do have some charity here on Schedule A, and there's taking the standard deduction, but that was part of the charity review that Ben just did. So we're not going to do that. But anyway, the point is, this client, I'm going to work up a projection for them. They have about $18,000 of total tax based on what I know about them this year. And the later in the year we go, the more I know about them. So I might recommend to this client, hey, look, your total RMD is, what was it, $61,000. And your tax bill, I calculate about 18,000. Let's just withhold 20,000, and then you don't have to worry about estimated taxes this year. That's a service we as advisors can provide to our clients. We have to help them do the RMDs anyway for that type of firm. And then also through the withholding, we can help them avoid having to pay for estimated taxes for, payments throughout the year. And they'll love that. They will really appreciate that service. It's a good example of something we can do for people. All right, rolling along. We took the salary deferrals, RMDs, capital gains harvesting. Another good reason to, actually, let me go back here. Another good reason to make that all households list straight out of Holistiplan is if you upload your tax returns into Holistiplan, something that we only did for one of these clients, but had we done it for all 100 of these clients, Holistiplan would have showed us and would have dropped into that spreadsheet what was their carry forward loss. It pulls it off of the tax return from last year. And so the next one we had up on our list was capital gains harvesting. It's something advisors do anyway at the end of the year. It's still a version of tax planning. So let me just show you an example. Who was it, Ben? It was Casey Berg. Casey Berg had a carry forward loss from last year of 21,000 bucks. There it is. And there's some amount of capital gain that I can harvest that first of all would offset that 21,000, but second of all, their income is actually low enough that I could probably even exercise. I could even realize more capital gains and still be in the 0% capital gains bracket. Like that's a super valuable thing that we as advisors do at the end of the year for clients. There's a shortcut within Holistiplan to do that. We have a thing called range calc. I'll click these three little buttons here. So first of all, I drew up a picture of what their 2025 income is likely to look at before I start realizing capital gains. And if you haven't used Holistiplan before, you can upload last year's tax return and copy that forward. Let's just do this though. Range calc. What range calc does is it takes that baseline I just made and then it adds income and then it shows on a graph like what's going to happen to your taxes as you add income. And here in this bottom group here shows me, it's a whole other webinar to show you how this range calc screen works, but it shows me that I can add about $78,000 to $79,000 of capital gains and not have to pay any tax on it. There's a little smidge here because of that $3,000 piece that you can offset against ordinary income. But in general, I can add $78,000 of capital gains and not pay any tax on it based on what I know about this client this year. So that's an example. Again, I feel like you don't need to be a tax expert to even do that. Like I can take last year's return, I can make a few little edits for this year. The advisor needs to be involved because they know the client best. But then anybody in the firm could then just run this thing and say, look, it looks like if we realized another $75,000 of cap gains, we could safely not pay any additional tax on it. That's a super useful thing that I think anyone in the firm can do. All right, Ben, you want to bring it home with Roth?
I sure do. I love how we save the thing that people use Holistiplan the most for the last 3 minutes of presentation time, but
Yes,
that's how we roll around here.
Yeah.
So I've got our last scenario up on here. These folks' last name is Bernard or Cruz or Ryan or all three. But these are retired folks who are taking Social Security, or at least one of them is, but aren't yet at required minimum distribution age. So they're living off of their non-qualified stuff to fund their living expenses. You know, we would hopefully identify these folks as potentially really good Roth candidates earlier in the year. You know, I think in the last session we talked about, you know, there's a benefit of doing Roth conversions earlier in the year when you at least can believe that more often than not, December markets are up relative to January. But we know that if we want to do a Roth conversion to account for this year, we have to do it again by December 31st. So here we've got our baseline situation. We've got knowledge of what their gross social security is. We've got some estimates around investment income. I saw a question from the last one about like, well, how do you know for sure what investment income is going to be halfway through the year? And the answer is you don't. And I want to disabuse people of a common misconception right now, which is you've got to get this down to the exact penny for how it's going to show up on the tax return. That is an exercise in false precision. And if you go down that road, you will be severely disappointed because you're probably never going to get it right unless you're doing your projections on December 28th, at which point, good luck finding your client to get them to sign the Roth conversion form. So what I want to start encouraging people to do as they're thinking about this is you want to be in the ballpark. Certainly without going dramatically over, but you want to be in the ballpark of where you're going to be. That's why in this case, I use round numbers. Nobody's investment income is going to come out with round numbers. I just want to know roughly where my clients are going to be when I'm doing this. So here we have a really good opportunity for a Roth conversion situation because these folks are so low income that they're actually paying $0 in tax. If you actually added it up, they have negative taxable income when you add everything together, right? Which is that's a situation you never want to be in because you can't have negative taxable income. You're leaving it on the table. So I'm going to go to what Roger highlighted before with the range calc feature, because using the range calc feature, I can fine tune how much of a conversion I want to do and predict or even show, right, here's how much of the tax implication it's going to be at various points along the way. So I'm going to open up range calc here. I'm going to focus on the top half of range calc, which is the impact of adding additional increments of ordinary income, right? Because a Roth conversion is ordinary income. And we can see starting from left to right, this left part is my baseline amount of ordinary income right now. And in this case, it's 0, right? I'm not going to spend too much time on this because we do like all, whole hour webinars on range calc to get into the nitty gritty of this. You're just going to take my word for it that what you're seeing is the impact of adding increments of $1,000 of ordinary income and the tax hits you hit along the way. As I go from left to right, I see that I actually don't incur a tax bill until I've added about $16,000. So even if I didn't do anything else, I could do a Roth conversion of about $15,000 or $16,000 and my tax bill is still going to be 0, right? That's free money that I can get out of a traditional IRA into a Roth IRA right now. Ignoring for a moment right now whether or not that's a good idea or not. We have another tool that can tell you the long-term impact of doing a series of Roth conversions. We're not going to get into that today. But I can also then say, okay, well, that's too little. I want to actually max out the 10% bracket. I could trace along to find the additional incremental income that would get me to the top of the 10% bracket. Or I could say I want to go to the spot where I don't have to pay any tax on my capital gains because my taxable income is so low that my client's capital gains stays in the 0% bucket. Again, these are concepts we cover in other webinars. We can probably put links up to show you where you can access those, either to sign up for a new one or to see recordings. But the concept here is you can then take this idea of, I know I have somebody I want to do a Roth conversion for. I can look at this and easily identify the spot where I want to do my conversion to. And then let's say in this case, I just wanted to make it at $85,000. So before I start putting those cap gains in the 15% bucket and I start phasing out my enhanced senior deduction, I can then go back into my scenario, build a brand new one by copying this one over, scrolling down to the Roth conversion screen, and we're going to give Leighton an $85,000 Roth conversion. I did that because it came out to the marginal bracket that I might want, or the tax bracket that I want. I still might want to know how much that's going to cost, right? So again, somebody said this before, they weren't aware that this was a feature. You can compare two scenarios in scenario analysis by hovering between them and clicking this little delta icon. That'll open up this comparison window. And now I can see that this $85,000 conversion is going to cost these folks about $7,900 or so in federal tax. Maybe I'm okay with that. Maybe my clients are okay with that for the long-term benefit, but you can at least give them an idea of how much that conversion is going to cost inside the system. So Roger, I think we're at the point where you take us home.
Yeah, let's do that. Let me just share my screen because I want to
demonstrate that you know how to do it now.
Just to make sure people believe. Just to bring it home, I mean, the last part of a assembly line approach to any financial planning, but tax planning in particular, is you gotta like track your status. And so what I added to my little spreadsheet was this status column. This is complete. Different firms do it different ways. I mean, we talked about putting certain tasks with associates and then advisors. I've definitely seen cases where there is a review steps. So it's like we're going to do the first initial draft, and then I discuss with the advisor. These are all statuses that you get to build your own process. The key, though, is for me, process is what makes these things scalable. Because otherwise, again, like I know it felt a little frenetic in this call, in part because of my technical issues, but in part because I know it felt like we were going through a lot. But the reality is, those things that we went through are small, especially once you've done them more than 2 or 3 times. And so that's to me the main message is build the process, like build the tracking spreadsheet, build the process for like what is in or out of scope when we talk about an RMD review or a Roth review. What is in or out of scope? If you have infinite scope, yes, you won't be able to scale it. Limit the scope. And then so I'll just give one more bit of advice. We used to use this process within my old firm when back when I was an advisor. I really believed in the kickoff meeting to start the year, who's going to do what. I believed in meetings throughout because you learn things as you go. Like someone's like, hey, I didn't even realize that you could bookmark this and therefore it's faster to do this. Like that's one of the benefits of having everyone in the firm working on a similar project together. You're learning together and improving together as you work on it. And then similarly, my final note, Alana, then I'll disappear, was do a post-mortem meeting also, right? You just went through this. It's January 5th. You all came back from the holidays. You managed to get everything done by the end of the year, and everything in every fiber in your being wants to move on to whatever the next thing is, which maybe it's tax letters in Q1. I don't know. But take the time to like go through what you learned. Like, we really should have a marker on our clients to say who's maxing, because that would go a lot faster next year when we try to identify who those people are. While it's fresh in your mind, act on the things you learned so that next year, when you run the process again, you're that much more efficient. You can take the things you learn and apply them the next year. Do that post-mortem meeting. Okay. I don't know. Do we want to try to do questions, or should we probably killed ourselves with time?
Yeah, I think we're out of time. But we will we have questions that you've sent. If they didn't get answered in the Q&A, we have those.
Yeah, we're around. We're around.
Yeah.
Yes.
Yeah, I'll share them with Ben and Roger. We'll send out some follow-up emails with some answers. Thank you, Roger and Ben, so much. Great job conquering those technical difficulties. And thank you for going through all the strategies step by step. I think it's super helpful to see those modeled out and to see that foundation for building out those processes. If you all learned something from this session, would you send a shout out to Roger and Ben in the Q&A? Because I think after this technical difficulties, I'm going to have difficulty convincing them to do this again. So I think they would really love to see some positive affirmations. All right, we're going to take another short break. We will be back at 1:05 p.m. Eastern with Jamie Hopkins. So I'm going to throw up a little slide here that has the rest of our agenda for the day, and we will see you guys in a few minutes.